December 2014, question 2B. Bensto Limited manufactures a standard water heater. The data below relates to its production activities. We have the selling price, the variable cost, production, selling, contribution. Additional information is the company has a production capacity of 320,000 water heaters per month. The company has in stock 10,000 water heaters. Expected sales for the month of December 2014 at regular prices are 300,000 water heaters. The company has received a special order of 60,000 water heaters at a price of shilling 1,700 per unit, and delivery must be made within 30 days. Assume that 40% of any sales lost during the month of December 2014 could be recovered in later months. Variable selling cost on the special order would be shillings 200 per unit. You are required, Helen, we are discussing the question that we had, the handout. The handout, we are now on page 8, page 9. Where what we were doing last time. Okay. Number 2, the lowest price Bensto Limited would charge for the special order so as to be different between the existing production and the special order. Number 3, suppose the special order is for 50,000 units per month at shilling 1,700 per unit for the entire year, and expected sales, regular sales are 300,000 water heaters per month with no beginning inventory, and sales lost are recoverable. Advise the management on whether the offer should be accepted. Okay, let me see whether I have that question or those questions in the group. Erin, have you found them? Or someone has forwarded. Yeah, thank you, Jack. So Helen, you should be able to access them. It has been forwarded. Thank you. So this is the question of December 2014, question 2B. December 2014, question 2B. Now this question is on what we call special pricing. Special pricing. Special pricing. We are going to have a table. We are going to have a table which will be divided into two. Divided into two. So in this table, we have details. The first one is recoverable. Let me call it recoverable. The second one, we call it irrecoverable. Irrecoverable, coverable, and irrecoverable. Now, the first thing is to get the stocks. So the opening stock, we are told by information number 2 that it was 10,000. It was 10,000. Then we are told, or we will say, add production. You add production. According to information 1, production is 320,000. 320,000. When you add production, you get what we call available for sale. Available for sale. So the available for sale is 330,000. 330,000. Then you less special order. Special order. Now, special order is 60,000. Special order is 60,000. So what now remains is available for regular sales. Regular sales. Available for regular sales. So that must be 270,000. Then you say less regular demand. Regular demand. So regular demand, according to information 3, it is 300,000. It is 300,000. When you do that, you get a figure we will call lost regular sales. So we are going to lose 30,000. 30,000. Recovered. We are told is 40%. So 40% of this one is 12,000. Not recovered. So not recovered must be 18,000. Not recovered must be 18,000. Not recovered must be 18,000. So with that now, So relevant costs. Let us prepare. Relevant costs for the special order. Relevant cost for the special order. So the relevant cost for the special order, it is first of all production. So production, as you can see in the question paper, it is 1,200. So multiply by the special order, which is for 60,000 units. So multiply that and give me the figure. Multiply and give me the figure. Yeah, according to Jack, 72 million. 72 million. Someone else to confirm? That is from Jack. Someone else to confirm? Okay, Churchill confirms. Good. Now the next one is selling. We have selling. Now selling, we are told, as you can see up there, it is 300. But now they're saying it will be 200. So you take 200 times 60,000. 200 times 60,000. That would be how much? $12 million, according to Jack. It's 12 million. Yeah, be setting the figures. Yes, Royce, so confirms 12 million. Good. Even Churchill, good. The next thing that you need to bring on board is lost contribution. Lost contribution. Now, lost contribution is also a relevant cost. And if you look at the question there, we are going to lose a contribution of 900 shillings. I told you when we covered these things that you don't see your customers as human beings, but you look at them as money. So for every unit that we are going to lose, you can see here, when we decide to go for the regular, for the special order of 60, we are losing 30,000, although we are able to recover 12. So what we need to account for is this one, that will not be recovered. So this 18,000, for each one of them, we are losing 900. So multiply by 18,000. Multiply by 18,000 so that we know how much is that. Yeah, Jack says 16.2 million. 16.2 million. Yeah, even Churchill confirms that is good. So the total so this is the relevant costs. Relevant costs. Give me the total of that. $102 million according to Churchill. 102 million. 102. Then from there, let's bring what we call the special price. The special price or the special revenue. According to information 4, each of this is going to be sold at a price of 1,700. So we are going to take 1,700 multiplied by 60,000. Multiplied by 60,000. You multiply by 60,000, and you tell me how much that is. Yeah, 102 million. Good. 102 million. So what is the advice that you will give? Are we going to tell them to reject the offer or to accept the offer? What do you think we should tell them? Should we advise them to reject or to accept the offer? Yeah, good. We should tell them to accept because they will get more than what they are incurring. So the advice is that they should accept. So that is about special pricing decision. And as you know, and as you have seen, is that we simply compare the special price with the relevant cost. Relevant costs are the costs that will increase when you do something. When you do something extra, that is what we call the relevant costs. Good. Now from there, we have advised, that is Roman 1, we already have advised the management on whether to accept the special order. Then number 2, the lowest price vendor could charge for the minimum order so as to be indifferent between the existing production and the special order. The lowest price they could charge for the special order so as to be indifferent. Now, the lowest price we have always said should be equal to the minimum or to the marginal costs. To the marginal costs. Should be equal to the marginal cost. So, this is 100, 200. You divide by 60,000. That is the lowest price, or that will tell us the lowest price they should go for. The lowest price they should go for. $1,670, good. can see 1670. So that means if they were to pay 1670, we will be indifferent. We will not be able to say with clarity whether we take or we abandon, because either way there is no gain. Either way the net position remains. So that is the way to go about it. Next is, suppose the special order is now for 50,000 units per month at 1,700 per unit for the entire year, and the expected regular sales are 300,000 water heaters per month with no beginning inventory and sales lost are irrecoverable. Advise the management on whether the offer should be accepted. So we will come back here to our table of the stocks. We come back here to do the stocks again. So we are told that for the opening stock, it is now 0. The opening stock is 0. Then production obviously remains 320,000. Production remains 320. So the available for sale is 320. The special order, we are told now it is 50,000. It is 50,000 instead of 60. So that means we have 270,000, which is available. The regular demand still remains as 300,000. 300,000. So the lost sales still remain 30,000, but you are not recovering anything. You are not recovering anything. So the irrecoverable is 30,000. 30,000. So I would like you now to work out on your own. Finally, you will tell me whether we accept or reject. So utaitengeneza tu venye tumetengeneza hii. So I'm saying you will just arrange it like this. So here production will be by 50,000. Then here also 50,000. Here the lost contribution now will be for 30,000 instead of 18. And here the revenue will be 50,000. Then you will tell me whether we should accept or reject. Do the same on your own. Do the same on your own. Once you are through, you tell me whether we should accept or we should reject. Yeah, I can see Churchill saying reject, Royce reject, Jack. Okay. June, I've not seen your response. Nick, even Helen, I've not seen the response. Okay, sawa. I can see the response, June. Helen. Okay, good. I don't think I've even seen McKenna. Yeah, but all in all is 1,200 times 50. That is 60 million. Then 200 times 50 is 10 million. 900 times 30 is 27 million. So sasa hiyo 27 plus 70 is 97. 97. So 1,700 times 50,000 is 5 million. And therefore, we should reject. And therefore, we should reject that. We should reject. Okay. We proceed to the next question. you are okay, say my yes, we proceed to the next. June, I can see you. Yes, Jack, we need to proceed. Okay, Royce, yes. So let's proceed to the next question now. Go to the next question. The question of December 2014, question 3B. WMT Limited is a manufacturing company which has 3 divisions, namely X, Y, and Z, distributed in 3 countries. The company does not allocate corporate head office costs or interest on long-term debt to the divisions. The summary of the results of the company and its divisions for the year ended at 1st of October 2014 are provided below. So we are given that. Now, using the return on investment criterion for each division and the organization as a whole, advise the management on the most profitable division. You advise the management on, and then number 2, compute the residual income for each division. Compute the residual income. Then, assuming there is an asset available to X, which caused that. Okay. Well, I can divide in terms of I have division here. I have return on investment, and return on investment, we know it is income. You divide by assets, you multiply by 100. Then residual income, we know it is income minus cost of capital. Minus cost of capital. So design something like that. So division X, it is operating income is 720. You divide by the assets of 3,000, multiplied by 100. This was a bonus question to students. Give me that percent. Yes, June, I can say 24%. Jack, recheck your working. Supposed to be 24%. Yeah, good. Then for the residual income, it is 720 minus the cost of capital according to Roman 2 is 10%. So 10% of 3,000. 10% of 3,000. How much? Yeah, 420. You can see 420 coming very fast. That is 420. Let us go to division Y. Division Y, you do the same thing, 900. You divide by 6,000 times 100. Give me what percent that is. I can see June already sending 15%. 15%. Yeah, good, even Jack. On this other side, then we will say it is 900 minus 10% of 6,000. 10% of 6,000. Let me see the figure. Yeah, June, Churchill, good. 300. 300. Then on this other side, we come to Z. We come to Z. Z has 1440, and the assets are 9,000 times 100. Times 100. What percent is that? Yeah, I can see 16 from June. Yes, from Jack. 16. Yeah, so 16% here. Then on this other side, we will say 1440 minus 10% of 9,000. 9,000 June already has sent 540. Churchill, Jack, good, 540. So the question had asked us to say which one is the most profitable. So the most profitable in terms of this one is division X, and this one is division what? Z. The most profitable is then we go to the next. Assuming there is an asset available to division X, which cost 300 and has an annual profit of 60, advise the manager of division X on whether to undertake the project, commenting on whether this is in line with the overall objective of the organization. Okay, so let's go to the projects, the new projects. We can say new projects. For the new projects, oh, it was asking for the whole company. Okay, so let's first of all finish this one. Okay. Or maybe we can do for the company. Let's do for the company first. Thank you, Churchill. I had not noted that. Let's do for the company first. For the company. So for the company, what you do, utachukua ile income iko pale juu, 30/60, minus there are some additional costs. You see there is the variable costs. You minus 240, minus 240, minus 240, but the interest you don't charge. Remember we said interest should be added back. So that one we will not charge, interest will not charge. Then you less the 360, which is the fixed cost. You less the 360. And then you will not charge tax. You will not charge tax because these others that we have worked with, they are before tax. They are before tax. So we are not going to charge tax. So that one will not be charged. So now you divide by the assets, 19,500 multiplied by 100%. So I have said we are not charging interest because we say interest should be added back. We are also not charging tax, although ordinarily we charge tax. We work with the after tax. But if you look at the incomes in the divisions, they are before tax. So it will be unfair to use after tax for the company and for the divisions before tax. So it should be the same. Hope that is okay. So based on that, I can see 12.62. We have 12.62%. 12.62. Then for the residual income, you do the same thing. The 760 minus 2040 minus 360, that is the income. Then you minus 10%. 10% of 19,500. 19,500. Yeah, I can see those figures coming very fast. 510. 510. So down there, for the new projects, return on investment, this new project, we are told it is going to have an annual profit of 60. It's going to have an annual profit of 60, and the cost is 300,000 or 300. So when you multiply, tell me what percent that is. That is 20%. 20%. And if they wanted residual income, you would say 60 minus 10% of 300, and that obviously should be 30. That obviously should be 30. So if you are doing the appraisal method, the decision taken, and the explanation. If you have the appraisal method here, the decision taken, and the explanation, if you are using ROI, you will tell them to reject. Why? 20% is less than 24%. And if you are using residual income, you will tell them to accept. Why would you say so? It is because 20% is greater than 10%. Is greater than. That is how you can look at it. I told you when you're using the return on investment, as the appraisal, you only accept a new project if the new project has a residual income. If the new project has a residual income, If the new project has a return on investment greater than the existing divisional return on investment. So this new project at hand belongs to division X. And you can see currently division X is having 24. But the new project is coming with 20. So we should reject it because 20 is smaller than the existing. When you are using residual income, we take the residual, we take the return on investment and compare with the minimum required rate of return. If the return on investment is greater than the minimum required rate of return, we will accept. So you can see that here we are saying we accept because 20% is far higher than the 10%. So if you're okay with that, let me know so that we can proceed. Okay, good. I can see all of you saying we proceed. That is good. Yeah. So May 2014, question 1C, Cons Limited manufactures and sells 3 products, namely A, B, and C. The budgeted production overhead cost for the financial year ending 30th of June 2015 are as follows. So we have the setup cost, material handling, inspection, and the total. The budgeted details of the products for the financial year ending 30th of June 2015 are as follows. So we have the production size, batch size, number of setups per batch, number of material movements, number of inspections. So we are required using activity-based budgeting to calculate the total budget production overhead cost for each product. So that question of May 2014, Question 1B, 1C is on activity-based budgeting. Activity-based budgeting. So what you do, you start with each cost center or each cost pool. And this is what you do. Let us start with the setup. For the setup, OAL, it will be budget setup costs. The OAL will be budget setup costs. You divide by the driver. When you look at the data given, we should use number of setups per batch. So number of setups. So budget setups. Budget setups. Budget setups. Budget setups. So in proceeding with this, I will have the product here, and then I get the setups. The product and the setups. The product and the setups. So how you will get the setups is like this. You can see in product A, production is 10,000 units, and the batch size is 100. That means for A, we will need to do 10,000, you divide by 100. That will tell you how many batches you require. How many batches? And then each batch or each group requires 2 setups. So you multiply by 2. You multiply by 2. So give me that answer. Good. I can see we have 200. We have 200. Let us go to B. B, we argue the same way. It is 16,000. You divide by 200. Then you multiply by 3. You multiply by 3. That gives us how many batches? Rather, how many setups? 240 according to June. Yeah, good. Royce, Helen, also 240. 240, good. Then you do the same thing for C, which is 18,000. You divide by 300. Then you multiply by 6. You multiply by 6. I can see. Yeah, I can see June, Helen, Royce, 360. So total, give me the total of those ones. This is 400, 600, 800. Is that so? The total, is it 800? Yeah, good. It is 800. It's 800. So now let's go back and compute our OAR. We compute the OAR. So our OAR, you now take the costs of 448. You can just even bring it the whole of it, 448 million. You divide by 800. You divide by 800. $560,000 according to June. Then after that, we proceed and now say per product, A, we receive 560,000 times 200 batches. A, we receive 560,000 times 200. How much is that? $112 million. We have 112 million. 112 million. B, we receive 560,000 multiplied by 240. Multiplied by 240. $134,400. 134,400,000. C will be the same case, times 360. Times 360. $201,600. 201,600,000. That is about setup. That is about setup. Let us go to the next. Let us go to the next. When we go to the next, inaitwa materials handling. Materials handling. Materials handling. So for the materials, OAL will be equal to the overhead absorption rate will be budget material handling costs you divide by I think the best should be number of material movements. Budget material movements. So this then should be given as the material handling is 193,600,000. You are supposed to divide it by 16,530 plus 2938 plus 17,632. So divide that and let me know the answer. Yeah, I can see 3.51 from June. $3.51. And remember, this is per movement. Some other people to confirm. Yeah. Huh? June had said 3.51. Jack is saying that 513.61. Royce, that 513.61. Churchill is also saying 3.51. June has revised. I think the most popular is that 513.61. That 513.61. Churchill also confirmed yours. That 513.61. So with that now, we get per product. Product A then should get 16,530 times 35, 13.61. Churchill, have you confirmed? So if you are multiplying, this takes us to 58,079,973.3. Okay, good. It's confirmed. Churchill, June also confirmed this. Let's go to B. B, you say 2938 times 35, 13.61. It is 2938 times 35, 13.61. I'm getting 73,567,966.18. Yes, Churchill, it's confirmed. June, good. Let's go to number 3, or C. C, you take now 17,632 times the OAL, So if I say 17,632 times 35, 13.61, it is 61,951,971.52. 52. Yeah, good. It's confirmed. So then we go to the last one, the inspection. Let's go to inspection. Inspection. So the OAL will be equal to budget inspection costs, budget inspection costs, we divide by, this one we should go by budget inspections. Budget inspections. So this one again, we will have to record our figures like this. Have to record our figures. It is 308,800,000. You divide by inspections, 1188 plus 1782 plus 2430 plus 2430. Yes, I can see June, Jack, 57,185.19. 57,185.19. And this is per inspection. Per inspection. So when you do per product, A should receive 1188 times 57,185.19. B should receive 1782 times 57,185.19. and C should receive 2430. 2430 times 57, 185.19. So if you take the calc, I have 1188 times 57, 185.19 is 67,936,005.72. 1782 times 57, 185.19 is 1,904,008.6. 2430 times 57, 185.19 is 138,960,011.7. Yeah, 67, 101, 138, Churchill, June, good. So they are confirmed. Huh? The last one, differing kidogo. I think here one mwisho tumedifa kidogo, maybe it's because of the decimals. So based on that, now we can do our budgets. So the activity-based budgets, we have details. Now for details, we have setup costs, material handling costs, inspection costs, and the total costs. So we have product A. Product A in setup, it has 112 million. In handling, it has 58,079,973.3. Huko kwingine it has 67,936,005.72. very grabbing that utajaza on your own. Product B, here it has 134,400,000 hii ni merab, huku kwingine iko na 101,904,008.6. Then product C. Okay, Royce agrees with me. Even June, good. So judging, maybe we are differing because of decimals, but it's not a significant figure. 11 shillings when we are dealing with hundreds of millions or tens of millions, it's not a big figure. So for this one is 201,600,000, and this is 138,960,011.7. Get the totals. Get those totals. Once you're through, you write through. Kimaliza kutafuta totals, niambie you are through. Yeah, I can see we are through. We are through. Okay. Let us go to the next question. PQR Limited is considering introducing a new product. This will involve a fixed cost of sharing 60,000. There are three uncertain factors, namely selling price, variable costs, and volume. The product has a lifespan of 1 year. The variables together with the associated probabilities are given as follows. So we have that. Assume that the 3 variables are statistically independent. Simulate the problem and advise whether to introduce the new product or not. You simulate and you advise on whether the new product should be introduced or not. So this question of May 2014, question 4B, it is simulation in CVP or simulation and CVP analysis. We can label it that way. It is simulation and CVP analysis. So as you know, when we see simulation, we begin with Monte Carlos. So we are going to have Monte Carlo for selling prices. Monte Carlo for selling prices. And as you know, we begin with shillings. Then we have the probability. We have the cumulative probability. And then we shall have the range. So we have 40 here, 55 and 60. Probabilities are 0.3, 0.5, and 0.2. When you cumulate, this is 0.3, 0.8, and 1. Now, what you can see here is that the decimals we are given to 1 decimal. So we are supposed to multiply by 10. And I told you it is allowed, ama imekubaliwa, to add the decimals. As in, you can multiply by 100, you can also multiply by 1,000. What is not recognized or what you are not allowed to do is to reduce. If you have 2 decimals, you cannot multiply by 10. But before you settle on who to multiply by, you check how the random numbers have been given. If the random numbers are given in terms of 1 digit, like it is the case here, you should multiply by 1. But if they were given in terms of 2, in 2 pairs, and it is 1 decimal, you multiply by 100. So we pay more attention to the format of the random numbers. So based on that, I'm going to have this as 0 going to 2. June, I think this is where the other day we were discussing. So 0 to 2, then 3 to 7, and then 8 to 9. 8 to 9. So if we are okay with that, I seek to proceed to Monte Carlo for variable costs. If you have any question, you raise. If no question, tunaendelea. So we have shadings here. We have the probe. We have the cumulative probe. And we have the range. So this one is 20, 35, and 60. 0.1, 0.6, and 0.3. Cumulative, I have 0.1, 0.7, and 1. So there's a 0 to 0. Because that is the number, 1 minus 1. Then this one to begin at 1 to go to 6. This one to begin at 7 to go to 9. Then Monte Carlo for sales units or sales volume. Sales volume, we have units, we have the probe, cumulative probe, and the range. So this is 35,000. I have 45,000 and 50,000, 0.4, 0.2, and 0.4. So 0.4, 0.6, and 1. So this is 0 to 3, 4 to 5, and 6 to 9. And 6 to 9, those are the Monte Carlos. Churchill, you are saying the last variable cost is 45, not 60. Good. It is 45. Thank you. It is 45. Thank you. So let us now design the simulation sheet. The simulation sheet. Simulation sheet. Now, in the simulation sheet, we are told to do for 25 trials. So I will have trial number. But in an exam, not unless this is the only question you can solve in that question paper, you should not take all your time doing the 25. Or not unless you are very fast and within 30 minutes you may twag and pack at 25. But if 30 minutes end up without, actually how many marks did it have? I think I did not, or 16. 16 you could allow it around 20, 25 minutes. So if within 25 minutes utakuwa umemaliza ni sawa. But ikizidikana, just stop at around 8 to 10. At around 8 to 10. Actually, when the worst comes to the worst, we recommend between 4 and 10. Those ones are enough. Because what is more important in simulation is, number one, the design of the Monte Carlos. That's the first thing we check. Number two, how you design the titles of the sheet so that finally you get your objective commission. And then number three, how you are able to record the random numbers and pick the values appropriately here. That's all. Those are the three things we check. how you have done the Monte Carlos, how you have done your design so that we achieve the objective commission, and then ukishaandika random number, are you able to go and pick appropriately there? That's all. Yes, you will get all the full marks. You will get all the full marks. You will get all the full marks. Because the danger with some of these questions, they are simple. Unaiona ni rahisi na unaijua. Now, in the process, it ends up taking a lot of your time. By the time unamaliza, 1 hour is gone, and you still have 4 other questions to deal with. So that is the danger with them. But if you are fast enough, you can complete within 20-25 minutes, well and good. Or if it happens to be the only question you can do, then you can take your time. Okay. All right, so we proceed. Now, what I need for me to get the profit, I will need to come here and get the selling price. Selling price, I will have the random number and then shillings, which I want to designate as A. I want to designate that as A. Then I have variable costs. Variable cost will be random number and then shillings. That one we call it B. We call it B. Then I will have sales volume. Sales volume is random number. And then I have units, which I want to call C. Now, there is a fixed cost. There is a fixed cost, which I want to call D. And then finally, I will have profit. And profit will be given as A minus B multiplied by C minus D. A minus B multiplied by C minus D. That is how I will get my profits. So once you are through with that design, let me know so that we proceed. I still have 12 minutes. Royce has finished. June, Jack, Erin. One more person. McKenna. Yeah, good. So if you are finished, we can begin. Take the first random number for trial 1. It is 8. When you come to the Monte Carlo for selling price, 8 is 60. The next random number is 0. 0 for the variable cost is 20. The next random number is 6. Is 6. 6 is 50,000. And maybe let me also emphasize something. There are 2 ways of handling this question. One is the horizontal. Naona venye tunaenda hivyo. Unachukua moja, unaenda huko, unamalizia. There are some people who will do vertical. Vertical means anachukua hizi namba, kwanza anaweka kwa selling price zote anajaza mpaka 25. Then anakuja anajaza hapa zikifuatana. Like now hapa angeweka 806 hivyo. Either way is acceptable. Either way is acceptable, but the answers will be different and all of them are okay. Remember I've said our key thing is not to check the answer you got, but to check whatever you put there as your random number. Did you go there in your Monte Carlo and pick correctly? And pick correctly. So in case you see someone else doing it that way or come across a book, it is also okay. Now the next thing is fixed cost is 60,000. So work out that and send me the figure for the profit. Yeah, 1,940,000. 1,940,000. Good. Let's go to day number 2. Number 2, we have 0. 0, ukikuja hapa, it has 40. That 0 is followed by 4. 4, ukikuja hapa, iko kwa 35. That 4 is followed by 3. 3, ukikuja hapa, iko na 35,000. And this is 60,000. $115,000 profit according to June. 115,000. These are the numbers I need to mark them well. The figure over 3. Okay. 115,000. Day number 3. I have 605. So 6 is giving me 55. 0 is 20. And 5 is 45,000. Fixed cost 60,000. 60,000. $640,000. Good. 640,000. So after 5, so I think I did not pick correctly hapa. Is that so? Naona hii ilifaa kuwa 605. After 043, I should have picked 6 at 2. Okay, can we revise? Can we revise or we leave it that way? I think it's better we revise. It's better because let's leave it that way. Let's leave it that way. Let's leave it that way. Continue instead of changing. We got number 4. After sasa hiyo nimechukua kimakosa. Let's now take hiyo ilikuwa 605. Let's now take 691. Ndio inafuatana. I've put them in blocks. So sasa 6 is giving me 55 here. 9 is giving me 45. And 1 is giving me 35,000. And the fixed cost is 60,000. Fixed cost is 60,000. Churchill says 290. Someone else to confirm? This should have 2 values. To 90,000 from Churchill. Who else confirms? Oh, June, you are saying you differ because you revised yours. Okay. Who else did not revise? Okay, for June now she has a different figure because she revised hers. Those who did not revise? Okay, Jack is the same. Okay, so if that is the same, that's okay, we can proceed. Number 5, after 691, I have 673, 673. So 6 again gives us 55. 7 is giving us 45. And 3 is giving us 35,000, so that the fixed cost is 60,000. Here's June Churchill, 290,000. Number 6. After 673, now I have 862. 862. So 8 is giving me 60. 6 is giving me 35. 2 is giving me 35,000. And this is 60,000. So give me the answer there. $815 from Churchill. $815,000. And I think because now it's already past 7, we call it a day at that point. You can continue that way on your own to 25, or you stop at 10. If you have to stop, kidogo sana, stop at 10, then you get the average. Stop at 10, get the average. So we will call it a day at that juncture. And then we hope to meet on Friday, God willing, to proceed with the revision. Thank you so much for joining us once again. We really appreciate. Talk to your friends and tell them to join us also. Thank you so much and good night. Thank you, June. Thank you.